If you spend any time on financial Twitter or YouTube, you are constantly bombarded with strategies. How I made 300% with this moving average crossover, or the ultimate RSI bot. Here is the hard truth. 99% of that is noise. If you want to build a career in quantitative finance, or if you want to build algorithms that actually survive real market conditions, you need to step away from the forums and go to the source. You need to read academic research. But there are tens of thousands of papers out there. Most are overly theoretical, some are outdated, and many just don't work in practice. So where do you start? Today, I am cutting through the noise. I'm giving you my top 5 must-read research papers that form the foundation of modern algorithmic and quantitative trading. These aren't just interesting reads, they are the pillars that entire hedge fund strategies are built upon. Let's dive in. Paper number 1. You cannot talk about quant trading without starting here. This is Common Risk Factors in the Returns of Stocks and Bonds by Eugene Fama and Kenneth French, published in 1993. Why is a 30-year-old paper still relevant? Because it broke the previous paradigm. Before this, most people relied on the capital asset pricing model, which basically said a stock's return is only based on its exposure to the overall market, its beta. Fama and French proved that wasn't enough. They introduced the 3-factor model. They showed that small cap stocks tend to outperform large caps, and value stocks, stocks with low price-to-book ratios, tend to outperform growth stocks over long periods. The takeaway for you? This is the birth of factor investing, or smart beta. It teaches you that you don't just buy a stock, you are buying exposures to different risk factors. Almost every modern multi-factor model used by major quant firms is a descendant of this paper. Read it to understand the building blocks of return. Paper number 2 takes us away from long-term factors and into the world of medium-frequency trading. This is Statistical Arbitrage in the U.S. Equities Market by Marco Avellaneda and Jiang-Hyung Lee. If you want to build a pairs trading or a mean reversion bot, stop watching YouTube tutorials and read this paper first. Many retail traders try pairs trading by just picking 2 correlated stocks like Coke and Pepsi and hoping the spread converges. Avellaneda and Lee professionalized this. They use PCA, principal component analysis, to strip away market-wide movements from stock returns. What's left over is the idiosyncratic noise of the stock. They then model that noise as an Ornstein-Uhlenbeck process, which is fancy math for a process that tends to snap back to an average. The takeaway for you? This paper gives you a rigorous mathematical framework for identifying when a stock's price has temporarily deviated from its theoretical fair value based on its peers, providing clear entry and exit signals. It is the blueprint for modern St. Arbert. Okay, paper number 4 is where reality punches theory in the face. You might have a great predictive signal, but if you can't execute the trade efficiently, you will lose money. This is Optimal Execution of Portfolio Transactions by Robert Almgren and Neil Chris. This is the foundational text of market microstructure and algorithmic execution. Here's the problem. If you are a hedge fund and you need to buy $50 million worth of Apple stock, you can't just hit market buy. You'll push the price up against yourself. That's called market impact. Almgren and Chris provide a framework to balance 2 things, speed and cost. If you trade too fast, you pay high market impact. If you trade too slow, you run the risk that the market price moves away from you before you finish buying. The takeaway for you? Even if you are a retail algo trader, understanding this paper changes how you think about placing orders. It moves you from thinking about what to buy to how to buy it. It's essential reading for anyone interested in high-frequency or execution algorithms. Paper number 5 brings us into the modern era of hype, machine learning. Everyone wants to throw a deep neural network at stock data. Before you do that, read Empirical Asset Pricing via Machine Learning by Gu, Kelly, and Xiao. This is perhaps the most comprehensive study done in the last decade on what actually works when applying ML to finance. They compared traditional econometric models against varied ML approaches, trees, random forests, and neural networks across 60 years of data and 900 different stock characteristics. Their findings were crucial. They found that ML does add value, but not necessarily through deep learning. They found that allowing for nonlinear interactions between factors, which simple trees do well, was more important than the massive depth of a neural network. They also highlighted how quickly these signals decay. The takeaway for you? This paper is a reality check. It stops you from over-engineering useless deep learning models and guides you toward the ML techniques like tree-based ensembles that have empirically shown promise in asset pricing. Finally, paper number 5 covers one of the most robust phenomena in financial markets: trends. This is time series momentum by Moskowitz, Uwe, and Pedersen. You will often hear this referred to in the industry as TS-MOM. Most people know cross-sectional momentum, buying winners and selling losers relative to each other. This paper is different. It looks at an asset's past returns only against itself. Basically, if the past 12 months were positive, you buy. If negative, you sell short. They tested this across 58 liquid instruments, futures, commodities, bonds, currencies, over 25 years. The results were staggering. They found significant, consistent positive returns across nearly every asset class they tested. This paper provides the academic backbone for the entire CTA and managed futures industry. So there you have it, the foundation of factors, the math of mean reversion, the reality of execution costs, the truth about machine learning, and the power of trends. I've put links to free versions of all these papers in the description below. Reading these won't be easy. They're dense, you'll need to Google math terms, you'll need to reread paragraphs 5 times, but that effort is what separates the amateur copying code from GitHub from the professionals building robust strategies. If you found this valuable, hit like and subscribe for more deep dives into quant finance. Thanks for watching and happy reading.